Hello and welcome to this episode of Nothing Ventured News for April, and what a month and prior quarter it's really been. I think one thing that is super clear now is we are really seeing that absolute bifurcation. We have the giant winners at the top, but selective conviction at the bottom of the pack. This is not really a broad market recovery. I think it's more of a sorting mechanism. One of the things we've seen is that SVB kind of framed March and April as, this barbell effect that we've talked about on the podcast quite a bit. There's a lot of access driven late stage rounds on the one side, but a lot of conviction driven early stage at the other. But the middle has been completely hollowed out. G reported that global VC investment had hit, $30.9 billion in Q1 26, which is up from about $128 billion in Q4 of 2025. But they also said that the quarter was driven by an extraordinary concentration of capital, especially in those large mega deals that we've talked about on the pod in the past. The Americas alone drew about $270 billion in Q1, which is over 80% of the global total. And KPMG also highlighted that there were 10 mega deals above $2 billion in the quarter. What are we really seeing? I think what we're seeing is that the market is active, and certainly we're seeing that both at the very early stage and the very late stage, but it isn't broad, right? VC is back is not the way to think about this. Really what we're seeing is that the top of the market is back, but the middle is super thin. List enthusiasm is becoming a lot weaker in a market like this, and specialization is starting to matter more. We ask ourselves, right? Is this really, or is it a market that is increasingly being dominated by access to a few giant private franchises? And does that hollowed out middle make the ecosystem healthier because capital is more disciplined? Or does it make it weaker because there are whole layers of businesses that have stopped getting funded, and we may not see those exiting or returning any funds back to their VCs and ultimately the LPs that invested in them? So if you are not an elite late stage or truly differentiated early stage business, the question you got to ask yourself is, where do you fit? It would be lazy, as I say, to say that venture has recovered, but it would not be incorrect to say that capital has concentrated. And it's not the case that early stage is dead. SVB's point is the exact opposite, right? Disciplined early stage still works. But once you accept that April is that kind of barbell market, the next question is where capital still wants to go outside the obvious AI names. And again, we've talked about this a fair amount in the past, but let's get a bit deeper today. Well, the market is broader than AI, but broader still looks strategic. Outside of AI, money is still moving, but mostly into those sort of sectors that feel infrastructural, sovereign, or mission critical. Again, KPMG's Europe outlook said that investor interest is likely to persist in defense tech. We've seen that a huge amount over the last couple of quarters, but not just defense tech, obviously AI, but equally energy infrastructure and also fintech. Reuters, on the other hand, reported global investment in space companies hit a record almost $8 billion in Q1 26, up from just shy of $4 billion in the last quarter. The trailing 12-month space investment reached close to $19 billion, which is also a record. It would be fair to say that North America has still dominated space funding at around 70%, but Europe has been posting its strongest results since 2022. Renewed defense budgets, lunar missions, and SpaceX's IPO expectations are all helping sentiment in the space sector. It's not that AI isn't the story, but the non-AI winners are the strategic sectors, and we are seeing a heck of a lot more of those coming up. Now, these categories often come with harder moats, either state demand or hard assets, or even procurement-based defensibility. And this goes back to a theme that I've talked about several times now on the podcast. What are the moats that persist in the world that we're living in right now? I would say distribution, I would say proprietary data, and I would say hardware, all of which obviously are quite critical to some of these sectors that we've talked about. The one thing I think to watch out for is that proprietary data will start becoming less and less of a moat over time as models continue to get trained on more and more data. So the survivors outside of AI do not look like the nice SaaS kind of businesses, fancy spreadsheets with a nice front end that we've been used to. They look strategic? Again, the questions we want to ask ourselves cover a number of things. Are investors now explicitly paying for national relevance and hard moats, not just software margins? And I would argue that's definitely one of the trends. Is this a durable move into physical world and strategic technology, or is it just a geopolitical spike? We obviously have seen a lot of turmoil in the geopolitical space over the last several months and obviously the last several years. But one has to ask oneself, does that persist, or is it just sort of a spike in demand being driven by these one-off events? And does this make the next venture cycle more capital intensive by default? Remember what these sectors require. They require really deep capital pools to scale. Because they need both deep capital pools as well as longer timeframes, that still leaves a question around how DPI gets back into the hands of the ultimate investors. Again, this is not to say that the market has moved away from AI. It is still dominant, right? The point is that non-AI money has a distinct pattern. It isn't random diversification. It is still highly selective. But the strongest proof of that strategic turn is really what's happening in deep tech, autonomy, and frontier hardware. They're holding up because hard moats are back in fashion, as I've just mentioned, and investors are again paying up for what is genuinely hard to build. Reuters reported on the 31st of March that Saronic raised $1.75 billion at a $9.25 billion valuation. That's more than doubling its value as investor appetite for defense tech surged. Their space data shows the rise this quarter came less from a huge jump in deal count and more from much larger check sizes. And again, anecdotally, we're seeing a huge amount of this. Seed rounds in the UK used to be $1 million, a couple of £1 million at most. We're now seeing $5, $6, $7, $8 million checks being at seed, often on safes, not even priced rounds, as investors are backing highly research-intensive businesses to see how they will perform over the long term. The average space deal size moved to $68 million from just over $35 million. And KPMG's Q1 global report points to very large rounds in Europe too, including billion-dollar-plus financings for companies like Neurorobotics and Wave. Now, the market is not just funding more experiments, despite what I just said. It is concentrating into companies investors think can become infrastructure or anchors. So software has lost arguably a huge amount of its perceived moat. We heard from Mukund Jha on Emergent on the podcast a few weeks back. Their product, over the last year and a half, if they do a back of the envelope calculation around how much money would have been spent had those apps been built by traditional developers or dev shops, that number would have been about $2 billion. So software really has lost some of that moat. It doesn't cost as much to build software today as it did 3 or 4 years ago. But hard tech has gained by comparison because technical difficulty is becoming a feature again. Certainly not a bug. And this looks like a return to an older venture principle, right? If the moat is real, investors will tolerate longer timelines and more complexity. And we saw that going right back to the 60s and the traitorous 8 and all the others that were piling into the semiconductor industry at that time. But again, what should we be asking ourselves? Well, the first question is, are deep tech businesses being funded because they are better businesses or because software's moats have weakened so considerably? And does AI make frontier hardware more valuable by increasing demand for autonomy, sensing and compute, and infrastructure? Also, are funds being built for clean software velocity well adapted to what comes next? And this goes back to that generalist versus specialist question. It would be easy to romanticize hard tech, right? But there are longer cycles. There is friction in procurement. And CapEx still matters and costs money. It isn't broad-based. Again, the market is backing specific categories with believable strategic upside. So if the market is concentrating into those quality deals and defensibility on the way in, it makes sense that exits and liquidity are also becoming more selective on the way out. Liquidity has been improving, but again, it is still selective and it is very fragile. Better than it was is not the same as healthy. Now, Wellington's 2026 outlook showed IPO momentum, more M&A and secondaries going mainstream as 3 of the key themes for the year. JP Morgan said that the secondary market exceeded $225 billion in annual transaction volume in 2025, which was up 41% from the prior year record. Reuters reported that Cerberus publicly disclosed its US IPO filing on the 17th of April, signaling renewed confidence around AI-linked listings. But they also reported on the 2nd of April that private credit strains had triggered capped withdrawals and tighter lending, with investor concern focused on liquidity, transparency, and valuations. They added on the 21st of April that alternative asset managers were bracing for a tougher investor test around software disruption, private credit demand, and retail redemptions. So liquidity is now multi-track. IPO is just one route. Secondaries, tenders, and structured liquidity are now part of the main system. The best assets have more options, but the rest are still in longer holding periods and holding patterns or simulated liquidity and liquidity structures. April does not say that the exit market is fixed. What it shows is that the system is becoming more flexible and more uneven at the same time. So how should we think about this? Well, the first question is whether or not secondaries are solving the liquidity problem or just extending the private life of these assets that cannot yet clear publicly. And does selective liquidity make venture healthier or simply strengthen incumbents with more optionality? And if we really get down to the brass tacks, how robust is this recovery if geopolitical shocks can still rattle the system so quickly? It would be incorrect to say that secondaries are clean substitutes for real exits. They are useful, but they aren't identical. And the backlog hasn't disappeared by any stretch of the imagination. The best assets do have more routes out than before, but that doesn't go for everyone. And once liquidity becomes selective, geography starts to matter more too, because not all regions have the same buyers, rules, or strategic demand. Now, geography has begun to matter more now than ever, even while capital concentrates at the top, because whilst venture is global, it no longer feels borderless. KPMG have said that Europe remained resilient in Q1 of 2026, helped by a record number of billion-dollar-plus deals, even whilst activity remained concentrated amongst larger established companies. Reuters, on the other hand, reported that Europe delivered its strongest space funding performance since 22 in Q1. And they also reported that the European Commission awarded a €180 million cloud contract over 6 years to 4 European providers as part of a digital sovereignty push. Now, the winning sovereign cloud providers were Post Telecom, Stackit, Scaleway, and Proximus-led consortia. Reuters reported on the 24th of April that China plans to restrict top tech firms from accepting US capital without government approval. Now, I want to tie all of this up because I watched a really interesting Instagram post the other day. And what it posited was that the reason that China has developed its own tech, and we know this obviously, but it's quite interesting to see it in real time, because of the Great Firewall, which restricted access by the US hyperscalers into China. And that's why we have tech like WeChat, which not only acts as a conversation tool, but a payments tool and much more. Now, is Europe going down the same road, right? And if China is restricting more tech firms, does that mean we're going to see more innovation coming out of Southeast Asia? I guess the question for me is, if Europe does go down that track, how feasible is that? Because we're now 30 or 40 years into using the hyperscalers in our everyday lives, whether that's Google, Microsoft, or any of the others, right? Now, how realistic is it for Europe to come up with truly competitive products that can replace these tools? I think that is something that we are going to be grappling with and wrestling with over the coming years. Geography matters again because procurement, sovereignty, and regulation matter again as well. So Europe's story is not just about catching up, it is also about building category depth in those areas where strategic demand is growing. And like I say, venture may still be global in ambition, but capital flows are becoming more and more politically segmented. So again, what should we be asking ourselves? Well, does a more regional venture world create resilience or just more fragmentation? And if sovereign priorities shape demand, which regions become advantaged in a cloud, defense, data, and infrastructure landscape, and which ones lose out? And really, is Europe becoming more investable because it is finally maturing, or is it solely that geopolitics is forcing local alternatives? Now, again, this is not to say that Silicon Valley is finished. Clearly it is not, and that is not the point at all. And Europe is not suddenly broad and frictionless. The market is still selective, fragmented, and hard to scale in. But April is a month that makes it obvious that venture, whilst being global, is no longer one seamless market. So what are the things that may be missing from this narrative and are worth calling out explicitly? Well, there's a few stories in April that sharpen the shape of the market I think would be remiss of me not to mention, even if they don't create an overarching theme on their own. So Robinhood's venture fund invested $75 million in OpenAI, which repackaged elite private market access for retail investors. Reuters reported that OpenAI was last valued at about $852 billion in that story. They also reported that Alphabet is planning to invest up to $40 billion in Anthropic days after Amazon said it would invest up to $25 billion. So we're seeing this sort of Ouroboros eating their own tail with all of these hyperscalers and large companies really trying to stay at the forefront of where they see the winners in this AI race. Now, Reuters said that Anthropic's annual revenue run rate had passed $30 billion in April, which is up from around $9 billion at the end of 2025. So massive growth there. Now, France has decided to move its health data hub from Microsoft Azure to Scalaway, which is another signal that cloud sovereignty is moving from talk to procurement. So this retailization of private access matters, in the Robinhood story. It helps explain why elite private companies can stay private longer. And Anthropic's April momentum reinforces the concentration story in that giant corporates are locking in exposure to a very small number of AI winners. And we saw this in Q3 last year. We saw it in Q1 this year. Sovereign procurement is becoming a demand engine, which matters for venture-backed infrastructure companies across Europe. But are we seeing the early stages of public-private convergence where private company exposure becomes easier to distribute without going public? And does sovereign cloud procurement create genuine new venture opportunity, or does it mainly just benefit larger incumbents and later stage players? When big tech and giant corporates keep backing the same new AI names, or the same few AI names really, what happens to everyone else? And, I hate being a merchant of doom, but I do think we are going to see some consolidation in the market over the coming year. Now, it's not as if Robinhood has suddenly reshaped the market for retail, but it is symbolic. And that symbolism matters far more than the dollar amount. It is also not the case that sovereign cloud is purely anti-American in its politics. It is also about procurement, compliance, and of course, control. What April has proved is that the venture market is active but layered, and the layers are pulling farther apart. This has been Nothing Venture News with me, Arish Shah. Hope you have a great week ahead, and remember, stay liquid.